Hello everyone, my name is Ritika Srivastav. I am working as an assistant professor in GL Bajaj Institute of Technology and Management, Greater Noida. So today the topic of discussion is financial derivatives, and I will be covering the basic concepts of derivative market and its evolution, what is exactly the derivative is all about, how it works, and basically its features and many more basic concepts. So here comes the next, first of all we should discuss about the introduction to derivative. First of all we should discuss the definition here. Financial asset whose value is derived from underlying asset. So we can discuss this through this diagram, as if financial instrument is talking about. First of all, financial instrument is kind of financial instrument which derive from, in the sense we are talking about its dependency is on underlying assets, some underlying assets. So what is this underlying asset now? Let us talk about through an example. Yeah, when we talk about this example, let us talk about the basic activity or basic product example in your daily life, curd. This curd can be derived from milk value, yeah, because it is a part of milk. That is why here the milk is what? Underlying asset. Milk is your underlying asset and curd is your, you can say it is a kind of derivative, it is parts of derivative, you can say. So this is a basic concept, you can say, when we go to a derivative market or when we talk about a derivative concept. And next line it says that financial agreement that are made between two or more parties that draw their value from a base asset or base benchmark here. So in this case, what's it's talking about? Financial agreements, it says financial agreement, or you can say a contract. So it's a derivative is also kind of contract, you can say, between two or more parties. It can be a written formal contract you can made also with respect to, you can talk about derivative market, entering or investing into a derivative market, but drawing their value from a base asset. That is what we have discussed in the definition also itself. So its value will be derived from the base asset, as this is what? Underlying asset, same as underlying asset. So this is what is the concept, basic concept of derivatives, how basically it works or what is the concept here. Next you can talk about the features of derivatives. Here the first is maturity or expiration date of a derivative is the point at which it automatically expires. So here comes, we are talking about expiration date. What is this expiration date? From the last date, we can say it is the last date in which, on which the value of derivative will be valid. It will remain valid till this particular date. This is what is expiry date, expiration date or maturity date we are talking about. So basically when entering into or when investing into a derivative market, basically when we talk about expiration date or trading, so in the futures or in the other type of derivative, we will discuss later about the types of derivative. So basically we are talking about here expiration date. So it is dependent upon the also the time value, as if why? Because when we talk about expiration date, longer the expiration date, the longer will be the time value, as a vice versa, you can say. This is what the first concept you can say. The next point it is saying, comparing the value of the derivative to that of its underlying, the derivative's value can fluctuate tremendously. What this means? You can relate this point with definition we have talked earlier in earlier slide. Why? Because we have took an example of curd and milk. Milk is our derivative, milk is our underlying asset and curd is our derivative. So, in this example, we have talked about whenever the milk value or milk price will increase, eventually the curd price will increase, and vice versa you can say. And if we talk about the real example, original example of derivative market, when we talk about, we can took an example of index derivative. What is this index derivative? Basically, it goes through a stock market index. When we talk about stock market indexes, so it relates through this. So, when we talk about Nifty 50 stock index market, in this case you can say underlying asset is what? Nifty value, and our derivative is Nifty index or Nifty derivative, Nifty futures, and etc. So, in this case we can relate this point through this example. Whenever the Nifty value will go up, the derivative value will go up accordingly, and you can maintain your risk factor, and you can increase or profitability with respect to this. Then next point is what? As there are no tangible asset available for transaction, there are no established restrictions. So, it is a word restrictions here, no also, on the maximum number of unit that may be transacted. So, here there is kind of no restriction with respect to how many number of units you are transacting, in the sense you are going into transactions. So, there is no kind of restrictions available. This is what is the third point you can say. So, these are the features you can say. The next thing is evolution of derivative market. So, what this basically told, it's how it started, this derivative market, from where it started and how it started. So, in 1875, when we talk about the starting phase of this derivative market, here comes the role of you can say traders who in Bombay formed an association. Association you can say it's a committee. They are forming a committee and started transacting or started trading in a future contract. What is this future contract now? This is a type of derivatives. So, I am not getting in detail about this concept. We will discuss upon this concept later on, types of derivative. I am only discussing about the evolution, how it started and what are the add-ons, what are the development in the derivative market. Then after that, in 1995, SEBI given the permission. SEBI has given the permission requested by the exchanges to start derivative or to start trading in the derivative market. So, here comes the another development in the derivative market. So, SEBI has permitted for this trading. And another is what? 1999 interest rate swaps, OTC forward rate agreement, these two are also a part of or types of derivatives. So, you can say were approved by RBI. So, here comes also not only the role of SEBI, here comes also the role of RBI when we are talking about permission, when we are talking about approvals. So, in 1999, we got the approval from RBI with respect to these two types of derivatives. We will discuss upon in later on about the explanation. In 2000, what the permission granted by SEBI, again we got the permission by SEBI to NSE and BSE for trading in derivatives. And wow, now what is this NSE and BSE? National Stock Exchange, it is a national stock exchange, and Bombay Stock Exchange. So, here these are two mainly the stock exchange platform, trading platform you can say, from where the trading started, the stock market trading also started. So, in this 2000 year, the trading in derivatives got the permission from SEBI to the NSE and BSE stock exchange platform. In 2001, now stock and options introduced on NSE. So, here comes another type of derivatives, stock and index options. And in 2002, the future trading in commodities reintroduced. So, here comes the commodity world, one more world here comes occur commodities. So, you can also trade, or you can also make this contract, derivative contract of financial agreements in commodities also. Commodities, you can say agriculture, agro based commodities also you can choose, like kind of corn, the purchase and selling of the corn. This is what is commodities is all about, trading, future trading commodities reintroduced in the 2002 year. Last or 2008, in 2008 trading of mini index future, currency future and options, it started in 2008. You get the permission on NSE platform for trading in mini index future and currency future. This is also a like kind of types of derivative. Next, first of all, we should also know why this derivative concept came into effect for the particular traders or investors. Why this concept came? The major reason for investing in derivative. First is hedging and second is speculation. Hedging, first we will discuss about this hedging concept. In the finance industry, hedging is a risk management tactic which deals with minimizing the uncertainty risk. So, let us talk about the risk factor, or you can say let us talk about a short example. Like suppose you have invested in a stock market, directly in a stock market through a demat account. It's a demat account is a platform in that you can directly invest in the stock market, any of the shares you are investing. So, you make a portfolio, you have make a portfolio of your investment. Now, what any uncertain risk or uncertainty happens and you are thinking that you will lose your money, okay, you will lose your money. Now, what happened to basically manage this particular risk factor, you are like a fear, it's fear factor. To reducing this fear is the concept of hedging. This is what is hedging concept. This is what a major reason for investing this evolution of derivatives or investing in derivatives. So, they try to hedge or control their risk with respect to this derivatives, investing in derivatives. This is the majorly the investors or traders came into this investing in derivatives for this purpose, hedging purpose. Then second is what is speculation. So, few investor, not only their primary motive is not the risk factor, controlling risk factor, their primary motive is also to make a profit, making a profit. So, here comes the definition: art of purchasing and selling an asset while taking on significant risk with respect to making a profit from an assumption about the change in price level is known as speculation. So, we will discuss this one by one. It is the art of purchasing and selling. So, mainly when we talk about trading, we are talking about the purchasing and selling factor. So, purchasing and selling an asset now, but we are talking about here also the profit making through assumption. Assumption is what? Assumption is like suppose we are talking about Nifty value. I have already talked in previous slide the index derivative. So, let us talk about Nifty value. Suppose I am taking an example, 50,000 is the value and you are assuming the Nifty value will increase. in this duration. You are assuming this, the value will increase. So, automatically Nifty derivative, your Nifty derivative will also increase. So, this is a kind of speculation you are making, as a kind of assumption you are making with respect to changes in the price level, and you are trying to gain more and more profit through this method. So, these are the major reasons for investing in trading derivative market. So, here comes the advantages and few disadvantages of derivative. Advantage is lock-in prices. What is this? Lock-in prices is mainly when we talk about the hedging concept we have talked about. So, mainly what we are trying to do, we are trying to reduce our risk factor. So, for reducing this risk factor, we are trying to lock the prices at price where we will be getting the benefit, or at price we will be safe for playing in that particular stock market or playing in that particular trading platform. This is what is advantages. The next advantage is what? Hedge against unfavorable movement in rates. Hedging concept already told you, that's the kind of controlling the risk factor. Controlling the risk factor with respect to unfavorable movement. That's what we have talked about, like whatever the movement fluctuation in the price level, you are trying to control it. You are trying to hedge it, and you are trying to control it from moving downwards. So, this is what is another advantage you are getting, like you can control your risk factor. You will be not getting into a deep losses if market gets down. Next is to diminish risk. So, here one type of you can say options will be a good type of type of derivative for diminishing the risk factor. Mainly they use options type of derivative. These are the advantages you can talk about. Now, here comes the disadvantages. First is changes in the amount of time to expiration. So, expiration, we have talked about this thing in few features of derivatives. Expiration date we are talking about here, or you can say maturity date we are talking about here. So, when we talk about this expiration date, it basically talks about the last date of that particular derivative, trading in derivative or transacting in derivative. So, in this case, when we talk about changes in the amount of derivative, we can take an example, like suppose we talk about the changes in expiration date. Suppose the expiration date will all the longer, when we talk about the longer expiration date, the time value will be longer in that case, and the expiration date the shorter will be the time value. This concept basically it's a kind of disadvantage for us because it fluctuates with respect to expiration date. This kind of disadvantage for us. And the next thing is the cost of holding the underlying asset. Now, what is this holding is all about, and underlying asset, you know what is this underlying asset? The cost of holding is basically when we talk about you are entering into derivative market, you are thinking about like already you have entered into a stock market. You have already entered into a sort of transacting in the stock market, transacting into this particular underlying asset, and you are basically holding this thing. Eventually, it reflects your the cost you are paying, cost you are bearing with respect to holding it. Okay. So, this is what we are talking about, the cost of holding also, it is a kind of disadvantage for us. Because whatever we are controlling our risk, but we are paying, paying that particular cost of holding. Next is interest rate. So, it is a kind of also disadvantage because interest is also included with respect to trading market, that derivative market. In that case, it is also kind of derivative, you are paying for that. Next, Next we talking about here some of the participant in the derivative market. So we have talked about the two concept. Already we have talked about two concept, hedging concept and speculation concept. So just to explain you in detail, just to remind these two concept, hedging is what? Controlling the risk factor. So here comes the participant hedger. From this we can come to hedger participant, who is a trader who want to protect themselves from an uncertain risk. Okay. So who want to protect themselves from uncertain risks with respect to price movement, with respect to price movement. And what is this? Now it's talking about here whatever the price movement, if fluctuation occur in the trading market or stock market you have invested, whatever the price movement, you are trying to control that risk factor. You are controlling that risk factor. So that's why the hedging concept introduced, and here the participant under that particular hedging concept, hedger. Next is the participant is speculator. Speculator, who are speculators? Here its concept arrive from speculation concept. Speculation, we have discussed this concept as if they are trying to, investors are trying to increase their profits. Their motive is not only to control the risk factor, their motive is also to increase their profit, to gain in that particular market. So for that speculation concept occur, in that case the participant is who? Speculator. So trader who believe in taking high risk, that is what I have told you, for getting a high profit you have to take high risk eventually, with an intention of expecting a early and huge profit. Okay. So you are like expecting or assuming, or your target is to gain a huge profit depending upon the forecasted price movement. So we have discussed the concept of speculation what? So it depends on how you assume that market will go up, market will go down, eventually the other underlying asset will go up or down, it eventually reflect your derivative value. Derivative value it is reflecting. So through this concept you can gain high profits or you can gain more and more profits. So the speculator is one of that particular kind of participant in the derivative market. Next is arbiters. Another participant are arbiter. Trader who are risk averse. Now here in this concept, in speculator, they are taking high risk. So they are not a risk averse. Risk averse are who? They only believe in taking low risk. So in this concept, traders are risk averse, involve buying securities in one market and tries to sell in another market. They are trying to make it simple or balanced. They are trying to make profit, but kind of taking a low risk factor. So this is another kind of participant in the derivative market, and here come, so these are the participants. Now what? So this is the end to the derivative market basics. We have discussed about the what are derivatives, how it works, and also we discuss about the features, we have discussed about its evolution. Now you can refer to these particular papers also. One is the book, you can refer to this book and you can refer about the notes. Thank you so much.